Welcome to the daily update, where I'll go over the action in the market for Wednesday, December 11th, and we'll see how things look for Thursday, December 12th. Had a nice little bounce after CPI came out. It came in as expected, so it didn't freak the market out, and it looks like it was just a little bit of a relief bounce. Now, even with the up day, we're looking better with the S&P 500. That's improving based on price, but internally, we barely saw anything change. We're still seeing a mixed picture across the board. Some of the internals are not looking really strong right now. We do have PPI coming out on Thursday, as well as jobless claims. We'll see if the market reacts to that. It's pretty much certain now that the Fed will cut rates next week at their meeting. That got locked in by last Friday's employment situation report, and then CPI coming out this week. So that's pretty much nothing's ever for certain, but the probability is quite high based on what the market thinks will happen. We're seeing the mega caps. They're the areas that really helped the market go up in Wednesday's session. We didn't see an awful lot of participation across the broader market. Okay, before I get into all that, there's a thing called the SPX Investing Program. From now until the end of 2024, it's free. You can come check it out. There's a link that will take you to the website or to a video. You can email me here. You do get immediate access to the videos as they are available. Also, the daily video, what you're watching right now, is the real foundation of the analysis and commentary that I do. I do a number of different videos, mainly over the weekend. Those are all meant to tie into the daily video. Okay, so we had a gap higher open. There was a positive reaction after CPI came out. We opened up above R1 at 6,057, and we hit short-term resistance at R2 at 6,079. Then, as the day went on, we tried to come back down. It looked like, okay, we hit intraday resistance there. We were starting to break a little bit lower, and then some buying came in. That drove us back above R2, and we slowed down right about when we got to the 6,090 level, and we closed down below 6,090. We were up 0.82% on above average volume. Now that's encouraging. We did see a pickup in volume for the S&P 500 on an up day. We are still positive in the bigger picture, in the short, intermediate, and long term. We're seeing that weakness improve a little bit in the intermediate term, which has been bleeding over into the short term, and that's what we saw on Monday and Tuesday. We bounced on Wednesday. We'll see what the reaction is here going forward, and I'll go through a lot of charts to back all this up. There's all kinds of crazy stuff going on in the world, but as I keep saying day after day, the market is its own version of reality right now and really doesn't care what's going on. Okay, some comments. CPI was well received. It actually ticked up a little bit as far as inflation, and some of the areas within the report showed some inflation picking back up a little bit there, but it was the headline number. That is what a lot of the market traded off of there. The NASDAQ and NASDAQ 100 did set all-time highs. That's encouraging as well. Mega caps and growth did outperform. This is where we saw the strength on Wednesday. Not necessarily the rest of the S&P nor the rest of the market, but the mega caps and growth had a really good day there. We still have this non-confirmed Hindenburg omen, a parabolic SAR, even with the update. Now it switched over to negative after Monday. Actually, it was after Monday. It still remains negative, even with the update that we saw on Wednesday. On a short-term basis, our Williams percent R, one of our short-term indicators, it's looking extreme right now, but none of the other ones are. And the stochastics, which never really wore off being extreme positive, they're still looking extreme there. So we're not really back to seeing good momentum in the short term, at least yet. And the intermediate term, the Sean trend meter, that's been there for well over a week now. And one thing that did help the market is the bullish percent index for the NASDAQ 100. It's still giving us a very high reading, In fact, it gets into that extreme positive reading area where it could suggest good momentum. It didn't fall, where we're seeing some of our other bullish percent indexes actually going down. The scenario just got changed. It says that the rate cut appears almost certain now. Nothing is ever 100% certain until it happens, but this pretty much has locked that in. The dollar was up and interest rates are up, and in spite of that, stocks still went up anyway. We closed at 4.27% with the 10-year yield where we had been at 4.22%. We're still inverted with the 10 to the 3-month yield curves. We're uninverted with the 10 to the 2-year yield curve. We ticked up as far as sentiment, where we had dropped below 50. We came in at 48 previously. We bumped back up to 52, but we're still neutral overall. And we're positive with the trend. We still have the ADX showing that the green line is on top. It's a little bit of a strengthening trend now. It's trying to come down to its moving average, and I'll show you that chart. But for right now, it hasn't crossed below the moving average. And with the update, we are positive. I'm still keeping the momentum at mixed because we had those down days on Monday and Tuesday, and we're going to need more to see what goes forward from here to change the momentum back to positive. And we would like to see the internals of the market show more improvement than what they're showing right now. Okay, we did get the weekly MBA mortgage applications index up 5.4%. Last week it was up 2.8%. This was the big one. CPI came in as expected, up 0.3%. Last time it was up 0.2%. The core, this is what the market really pays attention to, came in as expected, up 0.3%, which is what we saw last time. And just to kind of keep tabs on this, because we know the government spends all kinds of money, they're actually spending more. We came in at a minus 366.8 billion. Last time it was 314 if you go back a year ago. Okay, here is a chart of the CPI year over year, which looking at the total reading, that's the blue line where it's starting to go back up. And then the core is really flattening out here a little bit on a year over year basis. That's the inflationary component that the market really pays attention to. And to have that flattening out was taken as encouraging. Then we look at a year over year measure of services when you take out energy. That's the blue line, which is going down. And the commodities are actually coming up, even though our charts show that commodities are in a downtrend. When we look at the markets, this is showing that core commodities are actually going back up, but they're still negative year over year. Here's the federal budget, which as this goes down, that means the government's just spending more and more and more money here. And then the receipts and outlays. In the trailing 12 months, this is year over year, where we're seeing a lot more outlays, basically money going out. That's the yellow line versus money coming in, which are receipts. And then here's our chart of the core CPI, just showing the main inflation component year over year, where we're flattening out on a year over year basis, coming back up just a little bit on a month over month basis. Then here is the headline itself, going back up a little bit here with CPI. And then we look at the month over month change, also showing a little bit of an increase there. Then looking at real investment advice, this is some charts that I got from Isabel Net. It's a blog that they have available. This just shows the cumulative change in the real S&P 500 versus real profits. Now, real means they take inflation into account. So we look at the blue line, which is the cumulative change to the real S&P, where it tends to be outperforming the cumulative change in real profits. Okay, because folks are anticipating that things will look better into the future. And when we're in a more positive environment, that's what we see. We see the blue above the black here. Then this is, you might want to pause this and look at this. When we look at things on a valuation basis, there's a number of different ways to measure that. And I mainly focus on the PE ratio, and I really only use that as a guide just to kind of be aware of it. I don't really base decisions around that. But this gives the current reading for these different valuation metrics. And here's the forward PE. In the weekly video, I also look at CAPE, which is historical, but it's smoothed out over a period of time, showing that we're really quite strong. here. And then over here on the other side, just talking about that we're looking pretty overvalued no matter how you look at it here. And then this is also taking into account interest rates. Okay, then Oppenheimer. Didn't he develop the atomic bomb here? Anyway, they're the most bullish. A couple days ago, I showed this whole list with Edward Yardeni and different brokerage outfits and what they're projecting where the market will be by the end of 2025. Well, Oppenheimer had the biggest. They came in at I think it was yeah, up 17% higher than where we're at right now. Okay. We'll have to see. These folks are wrong just as much as they're right, but we'll just have to see how things go. It came in around the 7,100 level. Now, we had a 20% year in 2023. It looks like we're going to get a 20% return in 2024. We're going to be able to see 3 years in a row like that? We'll see. Okay, then this is how much exposure there is to gold by the commodity trading advisors. Coming down a little bit, but they're still net long when they look at gold here. Equity flows, where's all the money going into? Still tech. That's the bigger area right now. And we have all the 11 different sectors here, but the growth areas are really the ones that are performing better. We have financials doing quite well at the same time. And then this is something that I'm going to update on the weekly video. I've been showing a chart for well over a year and a half that compares the CPI from 1966 to 1982 to where are we at now? Well, that chart hasn't been updated in about a year and a half. This is an updated version of that same chart. And we've been going, even though the colors are a little different, if you've seen this, we tend to see a light blue on the other chart. This is a dark blue line here. And this is what was happening from 66 to 82. And then the light blue line, this is what CPI has been doing now. And we're in this decline overall. And that's really helping the economy. It's helping, well, but there's still a lot of inflation at the personal level. It's helping the stock market an awful lot. But then the thing to be aware of is look at what happened after that. This went into the mid to late 70s where we had stagflation. I grew up during that time and awful lot of inflation, but no economic growth. And that's what they call stagflation before it really came down going into the early 80s. Now, we don't know if it's going to play out the same way this time or not. We want to be aware of this. We want to know that things can change. The way they are right now is not necessarily the way things are always going to be. We've got a new administration coming in, all kinds of crazy geopolitical stuff going on. We've got Bitcoin finally nearing right around that 100,000 level. We have gold that's been going up really strong. Stocks have been going up really strong. Just all kinds of variables that could feed into this that could change what we see going forward, but we are matching up fairly close to what we've seen in the past. Now, we don't use this to make decisions. We just use this to look at it from an informational standpoint and then keep an eye on it as things develop. Economic surprise index. When we were going up, this is when the market was getting under some pressure. And then when this is going down, meaning the economic reports that are coming out, they're weaker than expected. And that's really been helping things lately with the stock market going up. Then the NFIB Small Business Optimism Index, this is what we received earlier, and it just showed a real improvement here. And that bodes well too, because most people work for small businesses. Then the implied US recession probability, this is what the market thinks here, where it's coming down with the overall reading. And crypto has boomed in recent years. Yeah, look at this. I was kind of following this a little bit closer back in 2022 or so, and we were getting under that $1 trillion level. Now we're up well over 3.5 trillion as far as market capitalization. And it's seeing a lot of real interest and improved prices lately as the new administration coming in tends to be more pro crypto based on what we're being told, and the market really likes that. Okay, here is one chart that I found on Twitter. I show this from time to time here. This is the risk appetite and what is the near-term outlook, where most people are thinking we're going to be up, okay, in the next 30 days. Now, the market likes to sometimes defy that. You can see that there are really big swings. When we're going to be up, all of a sudden we're going to go down. Oh, we're going to go up. Oh, we're going to go down. Yeah, this thing tends to swing pretty wide on its readings. But where is most of the strength coming from? Even though we've been seeing some profit taking, and that's still kind of continuing, the financials have been doing quite well, and then tech and industrials and communication and discretionary. Now, the things that we like to see doing well are the tech, communication, and discretionary. Those are more of the growth areas, and those are the areas that really help the market to go up when they're positive. They can also really drag the market down when things are negative. And we see things like utilities, which historically have been more of a defensive area. People get into that when they're worried about the economy. But you could also make a case that it's a growth area because of all this shift over into the green stuff and all the different regulations that are going on. And then staples tends to be more defensive, and then real estate has been under pressure, has been under pressure mainly because interest rates have been going back up, and that really threatens being able to get mortgages at lower rates. Okay, here is our chart. This is the reaction after CPI came out. We gapped up above R1, and then we kind of stalled out right here at R2, and it looked like a couple of times we were going to break down from here, but we weren't quite ready to do that yet. In fact, we broke above R2, got up to around the 6090 level. We still have 6100 to go. That has acted as overhead resistance already, which really is more of a mental area. But now that we stopped at that area, it also becomes kind of a technical area as well. We'll see if we're going to see more follow through to the upside here. We saw a little bit of a drop off under the 6090 level going into the close. And a little bit down, but not too much in the initial overnight session here. And things were pretty quiet. And then CPI came out, and that's when we saw the real positive reaction that then went over into the cash session. Okay, this is also looking positive and never really has turned negative, even as we've been under pressure earlier in the week. The blue line is above the red line, and the blue line's going up where the red line's going down. That means on an intraday basis, growth is outperforming value, and that is more positive for the market. Also, we look at a growth to value ratio for the S&P intraday. This kind of bottomed out around the 27th or so of November and has really been showing an improvement here. Even with the weakness that we've seen over the last few sessions, this has held up fairly well and did pretty good in Wednesday's session. This is one of the reasons why I say the weakness that we're seeing right now at this point after Monday and Tuesday looks like a pullback. We're not seeing a lot of deterioration from the big leadership stocks. Where we're seeing the deterioration is more inside of the S&P, the rest of the stocks that aren't necessarily leadership areas. Okay, here's our end of day chart. You see growth was up really big here, where value was actually down. And we've seen the opposite of that recently. And growth was up more with the mid caps and also up more with the small caps. So we're seeing our growth to value ratio for the small caps just getting ready here to generate a golden cross. This is showing a much improved scenario right now. And we're also seeing a recent golden cross here with the mid caps as the growth to value ratio is improving there. We're also looking pretty healthy here with the S&P growth to value ratio. End of day going up here when we compare the growth versus value ETF. That's looking pretty solid and getting close to where we were back over the summer when we hit that all-time high in July. And then since that time, it was the bigger stocks that were actually lagging. Now they're coming back and showing more leadership, and that's really helping the performance of growth versus value here. And we're still looking good with the discretionary to staples ratio. This has seen a big improvement, especially since we had that big down day last August on August 5th. The discretionary sector has been the best performing sector since that time. Large cap growth setting another new all-time high here. So looking at our trend, we still see the ADX pretty much on top of the moving average, but it hasn't necessarily crossed below it yet. We are positive since the green line is on top and going up and the red line's on bottom and going down. We're above 20. So this is a strengthening positive trend. Unless we drop below the moving average, then that will be a weakening trend, even though we'll still be trending. The short term also coming right down to the moving average, looking positive. So the trend has never changed from positive to negative based on the ADX charts here. It's the other areas that I'll go through here in a moment. And for the last few days, we have seen a pickup in volume, according to this indicator here. And we did get the latest reading of the investors' intelligence coming in at 3.8. A week ago, it was at 3.91, coming down a little bit. Still could suggest that we're getting a little too exuberant here, but this could still go up higher than where it's at now. And the VIX came down, not very much, not with the big update that we saw with the S&P, but it did come down on the line chart. That's the closing value as well as the bar chart. And we're also still going up. Now that's strange. Usually the VIX of the VIX and the VIX tend to move together. And to see the VIX go down and the VIX of the VIX go up, it's not normal. And the momentum for the VIX, we saw just enough of an upward move here where the MACD is now suggesting that the momentum for the VIX is up. But overall, in the bigger picture, this is the time of year when we tend to see the VIX go down, but it's not a straight down move. There are times when it will bump back up, and this could be one of those times. And we ticked back up here with the skew index. We were getting a very high reading. Then we had 2 down days. The skew index started to fall. Well, with the update, now it's ticking back up. This probably means that the market is still expecting some kind of a big move to the downside that hasn't happened, at least yet. And we went up with this fear gauge and we were down just a little bit with this other fear gauge. So seeing a little bit of a contradiction there. And we're still going up when we look at the risk on versus risk off ratio. We were chopping around here for quite a while as the rest of the market was starting to participate in the upward move. Now, lately, as we're breaking to the upside here, this just means that the mega caps and the large caps are outperforming the rest of the market, and we're seeing that reflected in this ratio. And we actually went up a little bit on an up day. Kind of interesting there. The equity put call ratio. This goes up typically on a down day. Well, we were up with the S&P, and this also went up. And we're starting to tick back up ever so slightly with the 5-period moving average of the equity put call ratio after giving us a real extreme negative reading here. And this is a longer term version of that same chart, just to give you a little bit more perspective here. And then we take a 10-day moving average of the equity put call ratio. It's still continuing to go up. So we're seeing some more confirmation there. It's picking up some increase in hedging in the market. And that means that there are people that are anticipating some weakness that hasn't really seemed to have come about. We did see it in Monday and Tuesday session, but then Wednesday we shot up with the S&P. We'll have to see if it can continue to go up or if it's going to see more declines. It came down a little bit, but still above the band here when we look at volatility risk premium. And this tries to measure risk going out 30 days into the future. When that picks up, the market is anticipating more risk, which usually means downside moves. And this is where we're not really seeing much of an improvement here. We look at the advanced decline line based on price and volume. Even with the update with the S&P, we're still, if anything, just leveling out after we had been declining, but not really showing much of an improvement here. Not really seeing much of an improvement. We saw a little bit more of an expansion of the new highs, but a few more of the new lows being generated. So our 5-day and 10-day moving averages continue to go down. And we're still going down with the advanced decline ratio. We were already negative with the blue line. That had already dropped below 0. It's continuing to decline. And we were just barely positive with the red line. That's more intermediate term. That is in danger of actually dropping below 0 and turning negative. So when we look at the 19-day advanced decline ratio, we're below 0 based on price. We're also below 0 based on volume. With the update that we saw, you would think that this would show an improvement, but it did not. And we're bouncing off the moving average here a little bit with accumulation distribution, where we were looking at this being more negative. The fact that this bounced up off of that moving average and is going back up is slightly more positive. And we saw a bit of an improvement here with the Chaikin money flow, with the histogram going back up, but we're still declining with the red line. So I'm still treating this more as negative until the red line turns up, but it is showing an improvement. We really didn't see much of a change here with the chicken oscillator. We dropped below zero, which turned this negative, and it really didn't move all that much. And we're pretty much flat with the vortex. The green line is still on top, so we're positive, but it didn't go back up where the red line's continuing to go down. And not much of a change here. The cumulative advanced decline line based on price for the S&P actually went down based on price and volume. Not what you would expect to see with the solid up day. And we actually ticked up a little bit here with the NYSE advanced decline line as we were going up with the S&P. They were getting kind of out of line with each other. Now they're starting to hook back up. But the fact that the red line is kind of far away from the bar chart, that means there's a bit of a continued disconnect that's going on between the mega caps and the rest of the market. And we're also still declining here with the cumulative advanced decline line for the NYSE, also declining with the regular NYSE advanced decline line. We continue to decline slightly here with the other NYSE advanced decline line. Not what you would expect to see on an up day. And here, the common stock, based on price, ticked up just a little bit, but not very much, and actually still declining here based on volume. So we're coming right down to the moving average with the advanced decline line for the NYSE common stock, just a little bit above the moving average with the S&P, coming back up, but still below the moving average with the mid caps, and showing a bit of an improvement still above the moving average with the small caps. But you can see here, the percent of stocks inside the S&P above their 20-period moving average, just kind of blip, just ticked back up. Now we're still negative because we're below 50. And we're still declining with the 50-period moving average study, the 100-period moving average study, and the 200-period moving average study. If we were seeing more broad-based participation on Wednesday, we would see these lines starting to go back up instead of going down. Short term, here we're not quite back to an all-time high yet with the S&P, where the Nasdaq and Nasdaq 100 are. We're still above the moving average here when we look at volume. And we ticked up a little bit with the 20-period exponential moving average, but we're still declining with the 50 and the 200-period moving average study on the S&P. And we bounced up with the Stochk RSI, but we're still below the midpoint. This is a short-term indicator here where we are going back and looking extreme positive with the Williams percent R. It had been stuck up here for a few days, fell back down when we saw the weakness on Monday and Tuesday. Now it's starting to go back up, which could suggest that the short-term momentum might be improving based on this chart, but we're not necessarily seeing that on other charts yet. Going back up, but still not at really extreme with the CCI 14 or the CCI 20. Going back up in the short term with the short-term stochastic, still declining in the intermediate and long term though, and all three of these are still extreme positive. Saw a bit of a bounce here, but just a bit under the midpoint here with the force index. And showing an improvement here though. We look at the condition of the 20-period moving averages, our short-term trend, we had fallen below the blue line and the green line. Well, now we're coming back up to those lines. So if these lines can continue to be flat and start to go back up, that would suggest the short-term trend is still hanging in there and looking more positive. And we're still well above the simple and exponential moving averages based on 20 periods. Still up at the higher end of the +2 channel with standard deviation. So that's showing an improvement there based on price. And going back up a little bit, but still positive with the balance of power. This is the 50-period moving average study here. Just looking at the condition where we were starting to drop below the blue line. Now we're coming back up. We're still a little bit below the red line here, but these lines continue to go up. That's suggesting that for right now, the intermediate term trend is holding up. And we're still the lighter blue with the go, no-go system. That's slightly more negative. Now, the one thing that can happen is these can redraw. If we have another update, they might turn to a darker blue. So that's a little bit confusing at times. And going back up, still above the midpoint with our highest high value chart. And seeing an improvement here with the TTM squeeze. It picked up that upward move that we saw where we had a couple of days of dark blue, that's negative. Well, it's turning back to light blue, which is more positive. And a little bit of a move up here, but still positive with the ease of movement. A little bit of a decline actually with the Arun, but we're still positive since the oscillator's above zero. And a little bit of a tick up with the S&P McClellan oscillator. We would expect more of a bigger move up from what we've seen. So we're still declining with the summation index based on price and volume. Also, a little bit of a tick up with the NYC McClellan oscillator. So we're continuing to decline with the summation index based on price and volume. These areas have not improved. And slowing down a little bit with the Swenlin trading oscillator based on price. At least this is flattening out, but we're still slightly declining here based on volume. Did not see these turn up the way we might expect them to. Momentum starting to show a little bit of weakness here with the PMO. We've already turned negative based on price and volume, and we've spent the last few days below the moving average. And we're not really seeing much of an improvement here. Internally in the S&P, with the PMOs that are rising, it was flat. We're still declining with the buy signals, and we're flat with the PMOs that are above zero. Not much of an improvement here. But the slope oscillator has now turned back to positive. We're above this green line, which sometimes that just means we're showing good short-term momentum. But we're still looking more negative with a short to intermediate term MACD here. That's crossing below its moving average. So in the short term, looking better with the slope, a little bit of weakness here with the TSI. Those are our two short-term oscillators. Showing some weakness now with the intermediate term oscillators, where the longer term oscillators, a little bit of weakness here with the KST, but they're still positive. And still looking okay here with the Copic curve, another momentum oscillator. A little bit of a tick back up with the Sean trend meter, but we're not up into this darker green area. Still looking good when we base things around moving averages. All the lines are still continuing to go up, and not much of a change here with the money flow. Ultimate oscillator did tick up back up and is still above 50. On balance volume ticked up as well, and we're still above the advancing moving average. Rolling over a bit here, but we had a buy signal that was generated right as we were coming out of this kind of base that was set up. And that was a really nice move to the upside that the Pring bottom fisher seemed to pick up. And still looking positive here with the RSI 14, that's above 50, as is the RSI 9. That's the shorter term RSI. And we've gone from neutral back to positive with the Elder's Impulse system for the S&P, but we're still negative here. I was watching this chart as the market was open. Even until we really break through and set a new all-time high, the dots are probably still going to stay on top. And that's negative for the parabolic SAR. And we're still declining with the bullish percent index. Here we're going up with the S&P, and the bullish percent index continues to decline. Also declining with the NYSE bullish percent index, but we're actually hanging in there pretty good with the NASDAQ 100 bullish percent index. These are the biggest stocks. These are the mega caps, and it's holding this part of the market together for right now. And longer term, we're still wondering if this trend line is acting as overhead resistance. We technically have not broken above that yet. Even though we had the up day, we have not set a new all-time high, and we've not really gone outside of this upper trend line on a closing basis. And this trend line goes back to 2009. And looking a little better here, where we were turning more negative with the Heiken Ashi with the black candles, now they're turning back to the open candles. Still positive with the Kegi chart. It had started to point down, even though it was black. Black is positive, but now that it's pointing up, that's more positive as well. But when it points down, that was leaning more, it was picking up the weakness that we were seeing. The Renko chart is still positive, and we're still looking a little more negative with the three-line break. So not seeing a real across-the-board confirmation based on the different ways we measure trend. No long-term charts for right now. We're kind of focusing more on the short term. This got updated here, the Keller market model, positive across all the different indexes on all the different time frames when we look at stocks. And bonds are actually turning more negative in the short term based on price. We're seeing commodities bouncing back up a little bit in the short term, but still negative in the intermediate and long term. And we saw discretionary communication and tech. These are the three growth areas. And that's what performed well on Wednesday. And that's why the index went up. And we want to see continuation of this, but we'd like to see some of these other areas doing better than what they did, at least in Wednesday's session. And so we saw the NASDAQ. I think it got above 20,000 there. It's not really being picked up here, but we got above 19.8, then it was at 19.7, then 19.9, then back down to 19.7. Set a 4-year high. We did see a BPI cross with the tech sector above 70. That's good. That's positive. with the Nasdaq setting another all-time high, as I mentioned, and the dollar was going up with the euro actually crossing below 105 against the dollar. And seeing a little bit of a tick up, but not much with the equal weight. That's the red line here, where we're going back up with the S&P. That's looking pretty solid, but not setting an all-time high. This is just a little bit of a tick up. And so we're seeing this ratio between the weighted and equal weighted version of the S&P. It's going up as the bigger stocks are outperforming. The Dow ended up being down. It's not looking all that solid over the last few sessions. And the diamonds continue to be negative with the Elder's Impulse system here. Here we're setting a new all-time high with the NASDAQ. That's, of course, very positive. And we're setting an all-time high with the NASDAQ 100, which is also positive. And we've gone from neutral over to positive with the QQQs when looking at the Elder's Impulse system. The momentum for the NASDAQ 100 is still positive, showing a little bit of weakness there, but it's starting to turn back up now. And I tried to point this out yesterday. The small caps came down to this pivot point, and that was the low, and we bounced up and closed off of that. And we did see a bit of a bounce here, but we're still not really breaking out. We're still seeing a series of lower highs and lower lows as we've been pulling back over the last number of sessions. Then we look at the Russell 2000 small caps going back above 50 with the RSI, still above the 50-day moving average, but the momentum is still negative for the small caps. And it's still negative here with the small caps looking at the Elder's Impulse system. Also coming up above this pivot point here, which may be acting as support with the mid caps, but we're still negative with the mid caps. They didn't really participate as much. The small caps and mid caps, neither one really did. The Wilshire had a good day. That's a broad market measure, but not setting an all-time high yet, but it's still quite positive and a little bit off of the all-time high here with the total US stock ETF. The FANG index, that's where the strength was seen. These are the really big mega caps, the Facebook, Apple, Amazon, Netflix, Google. That has really been doing quite well lately and finally setting a series of new all-time highs. We set that high last July, and then for a number of months until we got into November, the mega caps were really lagging behind. Now they're starting to take more of a leadership role, which is positive, but we would like to see the rest of the market also come along. And we're just a little bit above the short-term trend line here. I've been following this. We'll see if we can continue to break above that. Apple was up, actually down a little over 0.5%. Amazon was up 2.32%, setting an all-time high there. Microsoft was up 1.28%. Google, this is what really helped the S&P. It was up over 5.5%, setting a new all-time high here. Meta also setting a new all-time high, up 2.16%. Tesla was up 5.93%. You get these big monster stocks all together having an up day, and that's why the S&P goes up. Nvidia was up over 3%, coming back up to its 50-day moving average. Netflix also up over 2.5%, setting a new all-time high. And seeing a little bit of a deterioration when we look at US versus world stocks here in a short-term basis, but still improving with a longer-term correlation. And then I'm really keeping an eye on the semiconductors, and I have an additional chart here. We've been concerned, at least I've been concerned, because we're breaking below the 50 and 200-day moving averages here, and we're seeing a death cross. When we just look at the SOX by itself, this is the semiconductor index here, and that's been causing some concern. And even with the upward day that we had, we're still below both of these moving averages. Then we look at a ratio between the semiconductors and the Dow. A little bit of an improvement here because the Dow was down as the semiconductors were up. But overall, we've been a little concerned as this ratio has been going down. Then I've also been showing the semiconductors to tech ratio, where this is improving a little bit, but overall, it's really been going down. Not like what we saw earlier in 2024 going into the summer, where the semiconductors were really leading things higher. Now they're actually underperforming, and we'd like to see that change to be more positive. And then we look at oil here, which has gone back up. It's up into the 70 range. And here's the dollar, which is in an uptrend as well. And we were up with the 10-year yield, which is kind of strange. Typically, what's been happening lately is if interest rates go up, stocks go down. and we went down with the 10-year based on price, coming back down to its 50-day moving average here. And still looking good with our growth to value ratios. This area has been holding up. When we look at the Qs to S&P, discretionary to S&P, and large cap growth versus large cap value. Those are pretty solid right now. And still looking good when we look at the large caps, mid caps, and small caps above advancing moving averages. And this is still showing an improvement here with the S&P outperforming the utilities. And if that continues to go up, that would be positive for the S&P. So what's our outlook for Thursday? The European Central Bank will be meeting and they're going to be discussing interest rates. So that could have some impact on US markets. We're still positive with the bigger picture of positive seasonality. There's still this weakness that we're seeing in some of our internal measures. And there was some improvement on Wednesday, but not much. So I just say little improvement here. We're going to get initial jobless claims as well as continuing claims and then PPI. So it could be pretty influential with the reports coming out and all the crazy stuff going on to see if the market even notices any of that. Then on Friday, we're going to get import-export prices, which is not a big market mover. And PPI is the really big one that's going to be coming out on Thursday. Seasonality, we are positive with the Dow for December 12th, where we're neutral to positive with the S&P and neutral to negative with the Nasdaq. So take your pick. And we're still kind of going through for the rest of this week. I'm following the green dashed line here, which is the S&P 500 during an election, where we tend to see some historical weakness here going into the early part of next week before we see some weakness even into next week too. But I've been kind of seeing the market, at least in Monday and Tuesday session, kind of following the weaker side of this. We'll see if that can continue to the downside or if we're going to see a continued improvement. And Thursday is one of the more positive days in 2023, and it's also been a positive day in 2024. All of the days have been positive in 2024. And then according to Tom Bowley, so we're coming up into the December 12th here. We're still in this weaker time of seasonality, according to his research. And then some the warning signs, we're still kind of a little wary about our smart money indicators. Accumulation distribution, that's looking better since it's bouncing off of the moving average. The chicken money flow, not really turning up with the moving average, and the chicken oscillator is still negative. Not what you would necessarily expect to see on an up day like we saw. We're going up with the 5 and 10-day equity put call ratio charts. That tends to be more negative. We're still negative with the S&P and NYSE McClellan oscillators and summation indexes. The bullish percent indexes are going down when you look at them for the S&P and the NYSE. We still have a non-confirmed Hindenburg-Omen, which is negative and kind of lurking in the background. Parabolic SAR is still negative. The Swenlin trading oscillator is negative. And we ticked up a little bit, but really no improvement with our 20-period moving average study of those stocks inside of the S&P. Positive signs. We're still positive with the Vortex. The growth to value and discretionary to staples, those are holding up. That's why I was saying this was a pullback, because even in Monday and Tuesday session, these areas were holding up pretty well. The oscillators that we follow are still positive, but some of them are showing some weakness. The Copic curve is still positive. The advanced decline line, we're just a little bit above it with the S&P 500, above the moving average there, but we have been showing some weakness there. And then the moving average studies, they're positive, but they're all declining right now. And the bullish percent index for the NASDAQ 100, that's one of the more positive looking charts after Wednesday's session. These of movement, the money flow, and the ultimate oscillator still continue to be positive, as is the momentum for the NASDAQ 100 and the financial sector as well. Then we have the Hindenburg Omen, no confirmation spike yet. And we have until December 19th for that to happen, which will be coming up next week. Okay, our conclusion. We are still positive in the bigger picture. And bigger picture, we also have positive seasonality, but we see this weakness that's been developing. It started to develop last week and was carrying over into the early part of this week. And the bounce that we saw just brought limited improvement. And we're still seeing a little bit of an improvement in the short term after pulling back. And at least for this week is when we're looking at the potential of weak seasonality. In the intermediate term, this is where we see more positive seasonality and a little bit of an improvement, but this is where the weakness has been developing, but we're still positive in the long term. Thank you. I really hope you found this helpful. Have a great day, and I will talk to you in the next video.